Hi, my name is Teocino. I have a bank in a garage, and I heard your comment about a bank in a garage. And
Some people wouldn't like that comment.
Well, the thing is, it's in the garage. I would prefer it to be in Wall Street or anywhere else, but you have to start in the technology world in the garage, like HP, like many other. Like Ponzi, too, I guess. It started in a garage. But that hasn't prevented...
Did you say Fonzie?
Ponzi.
Ponzi.
That hasn't prevented other guy to have 60 years later to pull the same trick. So what is the DFS going to do to allow people to start bank in the garage with the technological, get insurance, get other things than make a deal with the bank? Because the way I read the reg right now is bank in the garage need to make a deal with big bank. And if you cannot make a deal with big bank, DFS will not give a bid license. And the bid license are too broad from what I read, where there is not a clear definition of what bank in a garage need to accomplish to get a bid license. So is the DFS going to work much more on a progressive system that will allow the big bank, the bank in the garage, or whoever else to foster in New York State to make sure New York State residents are not trickled by the bank in the garage with a Ponzi scheme idea?
Right. So hopefully there won't be any Ponzi scheme ideas. But look, you're asking, implicit in your question is you're asking that fundamental, I think one of the hardest questions we face, which is what do we do about compliance costs? And the compliance costs, if they're too burdensome, if it's all too technical, if it's just too much, how is a startup with 3 buddies in a garage with a great idea, or in a basement, let's say, going to get off the ground if they face this enormous initial hurdle to move forward and get a license and to operate in, what I consider to be the greatest financial center in the world? And the answer is, I punted on it in the speech, and I think it's probably the toughest question we face, because we want to make sure that even if you're startup, you're doing certain things, because as we know, if there's an area of the market that goes unregulated or is very lightly regulated, it can, not always, but it can become sort of a dark corner where a lot of things we don't want to see happen. And those who want to aid terrorists and send money around the globe and engage in money laundering or sell drugs, or you choose your illicit activity, often flow to those dark corners. So we want to make sure there's enough regulation in place to prevent that from happening, but at the same time have it be not overly burdensome. And I didn't get into it in the speech, but we've had some very good proposals from some of the commentators who have submitted them to us about maybe a tiered approach or a safe harbor approach, and we're working through that, and we're just not there yet. So I wasn't prepared today to tell you how we're going to do that, but I commit to you that we're going to try and do it in as thoughtful and as careful a way as possible, because it goes back to that collision I started with, which is when you start engaging in banking activities, there's a reason there are tight regulations, because it's a lot of potential for a lot of bad problems, even at our largest institutions. At the same time, the tech world is changing the face of banking as we know it, a lot of the times for the better, and it's doing it in profound ways. And it's often driven by this technological innovation, often coming from startups, which start small. And we face this issue somewhat with our smaller banks, frankly. We have everyone knows the JP Morgans and the Citis and the Wells Fargos of the world here in New York. But in New York State, we regulate the whole state. We have 70, 80 banks in upstate New York, many of which are tiny. And when Dodd-Frank got passed, they had a huge problem, because the potential compliance costs from Dodd-Frank could put some of them out of business. And I remember sitting with certain CEOs when I first got this job from those banks saying, and now I'm in a position where I'm going to have 3 loan officers and 10 compliance officers. And I looked at the CEO and said, well, that's not a business model that will work. They said, I know, that's why I'm here to see you. And so that we worked that out over time. And it was hard, and it actually required us to spend a lot of time in Washington dealing with how we draw those final regs for Dodd-Frank in certain ways that don't crush our community banks upstate. It's sort of a similar endeavor, and that's what we're wrestling with. Of course. Yeah, that's what we're here for. And you know, and I don't mean that facetiously. You know, there's a whole group of about 15 DFS people here tonight in these first couple of rows, and they spend a lot of time talking to companies and startups and other people who want to get off the ground. We have other people who spend a lot of time talking to community banks and big banks, and you know, a lot of what we do is not enforcement. It's sort of prudential regulation. We want the banking sector to succeed in New York as much as possible. We want new companies, new tech companies succeeding in New York as much as possible. So I have no hesitation answering your question, yes.